Now we will move to the derivatives market, mainly focusing on the futures. So you know that derivative means you are deriving the value of any product with one or more basic variables. Now this basic variable is basically called a underlying or underlying assets. So you can have a underlying assets as equity, you can have a underlying asset as index, foreign exchange, commodity, reality, any assets. So we will take this with an example, we will simplify with the example. Now there is a wheat farmer and he is having a harvest and he knows that there will be a production of wheat which he wants to sell in future. So but he is not sure about what will be the future price of that wheat. So he wants to eliminate the risk of the wheat prices. So what he will do, today he will sell his wheat at a future rate. So he is deciding the price of the wheat for a future date today itself. So it is an example of a derivatives where he is de-risking his wheat prices today itself. And what will be the underlying in this case? The wheat price will be the underlying. So spot prices of a wheat will be the underlying in this case. Now we will move from derivative to the future. So future is basically a standardized contract which is traded on the exchange, where you will buy and sell underlying assets. In our case it is of say currency rate on an instrument at a future specific date. So what is a standardized contract means? So standardized contract means you will have a standardized lot size, you will have a standardized expiry date, you have a standardized rule on the tick size. So this is a standardized contract which is available. So when I say कि I buy 1 USD INR contract means I am buying 1000 lot. For the November expiry means my expiry date will be 25th of November. So all these things are standardized, and when you trade this for exchange rate, it is become a currency future market. Now currency future market is a linear product. So what is means by a linear product? So any profit and loss of the currency future market will be directly related to your spot prices. So if the spot prices move in one direction, your currency future prices will also move in the similar directions and you will have a similar payoff. So your payoff will be linear in case of currency futures. Now how the currency future market and the forward market is different? You know that in future also you are pricing for the future date, and in forward also you are pricing for a future dates. But how both are different? Because both are actually hedging against the future prices, better risk management, and this risk management is applicable similar to all type of market participants. But in case of forward market, it is depends upon the counterparty. So one bank can have a different risk management for one client and a different risk management for a different clients. So this is a basic difference between the future and forward. There are some other difference, like in India, that our future currency future is settled in the cash and foreign market is always settled in the physical. So there might be some additional differences. So why somebody should trade futures? The major benefit is a price transparency. Now whether you want to buy 1000 USD or you want to buy 1 million USD or you want to buy 100 USD million, the prices will available to everybody same, and it is available transparently. So that is the biggest advantage of futures. Second is it eliminates the counterparty risk. Why it eliminates the counterparty risk? Because all exchange traded currency future transactions are guaranteed by the clearing corporation of the exchange, and here everybody's are allowed to participate against the OTC market, where there are certain guidelines for participating in the OTC forward markets, and you may have a low cost of trading because of the tight bid-ask spread and higher liquidity as against the OTC market. And also the future provide a flexibility compared to forward market, because in future you can buy today, sell tomorrow, but in forward market you have, if you are trading through one bank, then you have to do square of the transaction with the same bank. So there is a less flexibility as compared to futures. But there are certain limitations also in futures. Since it is a standardized product, your hedging may not be the perfect. So what do you mean by that? So suppose I want USD on 15th of December, but the expiry for the December month is of a 25th of, say 26th of December. So you have to buy a contract of 26th of December, though your hedging is only up to 15 December. So there might be a mismatch in the settlement dates and it is become an imperfect hedge. And again, since in future we have a tight risk management, so you have to provide a margin on a regular basis. There will be daily mark to market will happen. So this makes either it is not making a cost effective for few participants, and also it making a cumbersome that you have to do daily cash in cash outs. So these are the two basically limitations of future. And in there is an additional limitation is that since it is a cash settled, so if you have an actual requirement of a currency of the USD, then you have to go to the bank for a spot market for getting that. So there is a basis risk also involved when you go in the spot market to buy a actual currency, since in future there will be only cash settlement. Now we will move to the pricing of the currency future. In case of currency, the future value will be determined by the interest rate differential between the two countries. So what do you mean by that? So we know that the theoretical future price for any product is a price where there is no arbitrage is available. So now let's see how we can find the future price of a currency using the interest rate differential. So let's take an example. Suppose the spot exchange rate of USD/INR today is 68. The risk-free return of US for 1 year is 3% and risk-free interest rate of India is 7%. So how we can arrive the future price of USD/INR? So obviously the 1 year interest rate in US is 3%. So I will borrow in US. So suppose I borrow 10,000 USD in US, and now I convert that 10,000 in INR. So I will get 68,000 rupees. Now I will invest that 68,000 in India, because the rate is higher, say at a 7%. So after 1 year I will get say amount around 74,600 odd after 1 year. So that is my amount which I get including interest, and now I have to pay in USD 10,300 because the rate is 3%. So if there is no arbitrage, my 74,600 should equal to 10,300, and it gives me the value of 70.6408. So my future price, if there is no arbitrage, my future price should be 70.6408. Now when I am doing this example, I am assuming that money can be easily transferable from one country to another country, and there is no cost involved in borrowing and lending. So simple way the calculation will be future rate is equal to spot into 1 plus R of INR divided by 1 plus R USD. So this is the way you can calculate the future price. So what do you understand from this? My spot price is 68, my future price become 70.6408. So you can see that in terms of USD it is trading at premium, and in terms of INR it is trading at discount. So what conclusion we make from this? If there is a higher interest rate in one country, then that currency will trade at a discount to the currency of a low interest rate, and vice versa, the currency with a low interest rate is at a premium to the value of the currency of a high interest rates. So in this case USD INR interest rate is low, so it is trading at premium, and Indian interest rate is high, so it is trading at discount in future. So this is a very important. So here we can see the example how we can calculate the future price for 6 months using the same logic which we have used for the 1 year. Only thing is you have to multiply by 6 and divide by 12, since it is only for 6 months. Now we will have one example. Now assume that the risk-free rate of JPY is 0.25% and Euro is 1%, and Euro JPY is trading at 123.40. What will be the future value of Euro? It will be whether at a discount or a premium. So logic is that Euro interest rate is 1%, JPY interest rate is 0.25%. So Euro interest rate is high, so it will trade at a discount, and JPY interest rate is low, so it will trade at a premium. So now in this case Euro will trade at a discount to JPY. So since it will trade at a discount, it will be around towards 122 point something, so it may be 122.40 or so. So how you can calculate 123.40 into 1 plus 0.25% divided by 1 plus 1% will give you the value of Euro JPY for 1 year. Now we will move to the basic future strategies. Basic future strategies are very simple, but here you have to remember one thing, when you are doing a strategies, you are doing a strategies considering the base currency. So what is happening to the base currency, and or what is your view on the base currency, and then you are deciding. So generally what happens ke I go long if I assume that something is appreciated, but in case of USD INR, let's assume that you are thinking INR will appreciate. So you will not go in USD INR contract. Why? Because your base currency is USD. So you have to think INR is appreciating against USD. So USD is depreciating against INR. So I have to go short. So you have to see from the base currency, and you have to always compare it with the another currency. So it is possible that INR is appreciating against USD, but at the same time INR is depreciating against Euro. So you have, when you are doing a transaction, you have to see the view with a comparison of the two currencies. So who will take a long positions? Anybody who requires underlying assets. Now in our case in USD INR, importer will require the underlying asset, so he will go long. Or any speculator who thinks that USD will get appreciated against the INR, he will go long. And in the short side, anybody who has to sell underlying, basically a exporter, he will go short, or a speculator who thinks that the USD is going to depreciate or INR is going to appreciate, he will go short in USD INR. So this is just a various business context is given, and what is the need of the currency and what is a hedging solution. So as I said, for an importer he will buy USD, so he will go long. For exporter he will sell USD, so he will go short. A tourist who is going to US, so he required a USD, so he has to go long. A person in India, he is going to receive USD, so he has to sell USD, so he will go short. A person who invested in US equities, again he is going to receive USD, so he will go short. A person who has invested in physical gold in India. Now this is very interesting. So Indian gold price is determined from the international price. So there is always an exchange risk. So you calculate, you take the international price and multiply by the exchange rate. So if you want to de-risk the exchange risk, you have to sell USD, because you want to de-risk the USD exchange risk. And a company which has to make repayment of loans, so he has to buy USD, so he will go long. So these are the various things which there might be any additional things, but these are the various business context and how you can hedge your position by using currency future market. So this hedging amount and hedging underlying and the tenor will depends upon your need. So if you want to have an import after 3 months, then you will buy a future of a 3 months and so on. So your hedging will depends upon what is your underlying asset, what is the time period. So for example, if an importer who has to make an import payment after 3 months, then he will basically long future of a 3 months contract.